It's crazy. And then, on top of that, when we have people who they'll get the notice will say you need to respond by January 25th. And they'll come to you on January 21st, like, oh my God, I need help. Like, it's a fire. And it's like, when you get the notice, call your CPA, email them, whatever you got to do, and just start working through that process, because you want to do it right. You want to get it right the first time to maximize your chances of winning that audit and coming out the other side in a favorable position.
Hey, Thomas, thanks for coming on. I'm excited to jump into a lot of tax stuff today because obviously I'm in the real estate business as an investor, but also we do loans. And so I've done, probably 10,000, helped 10,000 people out and done loans for 20 years. And my wife does commercial financing. So I pretty much look at tax returns all day long. And I can tell if the CPA is good or not by how they file or what they do. And I've caught a lot of mistakes and pissed a lot of CPAs by saying, I don't think you do this right. But before we jump into that, which is going to be good because we can help a lot of people today, I think I'd like to get a little background about, I know you're not just a CPA, how you got into it. You're also an investor, but I'd love to hear your background and kind of how you got to here today.
Yeah, absolutely. So I went to college for accounting. So my family was like, go to school for accounting. When I actually got into college, everybody's like, if you're going to get a degree in business, get it in accounting or finance. Those are the degrees that, are worth something. That's what they told me. So that's what I did. But around my sophomore year of college, I started to realize, I'm like, if I really want to get to where I want to go in life, I'm going to need to do something else. So I picked up the Rich Dad Poor Dad book. And from there, I learned about real estate, and the rabbit hole goes pretty deep. But then I started to attend these like meetup events. And at one of the local RIAs, they had the Real Estate Investment Association near me. There's a group of people who was putting on a 3-day weekend on real estate syndication. So I went to that 3-day weekend and learned, they give you a crash course in syndication. And I fell in love with that business model, continued to go to their events. And I started investing as an LP with some of the money I had on the side. And they basically said, hey, look, if you ever find a deal that's a good deal, we'll syndicate it with you. So I'm like, okay. So I started building broker relationships and ultimately found an 82-unit apartment complex that we syndicated since went full cycle. So it's kind of how I got involved on the investment side. Today, I'm mainly on the LP side still, investing as a limited partner. But then around that same time we did that deal, actually, I decided, hey, you know what, let me take my accounting background and go help real estate investors with it. And that's when I met Brennan Hall, and at the firm where I'm at today, where we've been fortunate enough, we've been able to help a lot of real estate investors reduce taxes. So that's kind of a brief crash course on how I got here today.
That's awesome. Yeah, I've had Tom Wheelwright on, which I'm sure you know who he is. Wealth Ability, Robert Kiyosaki's buddy. Yeah, Rich Dad Poor Dad's funny because it's a book about a mindset change, right? It's like, it's not telling you it's not telling you the 101 to buy real estate. It's like telling you got to think differently and change your mindset. It's amazing how many people have read that book that are real estate investors. It's that I've talked to. I think every real estate investor probably read the book,
Yeah.
Before we jump in, what was your aha moment where you saw like, wait a minute here, I need to, because I agree, because I'm excited to go down the rabbit hole of, man, people need help. They have the wrong CPAs. They're not getting the right advice. Like, what was the aha moment for you when you just like, I need to start helping real estate investors out. I need to dive into this.
Yeah. So what kind of happened for me? So I started off my accounting career at a national accounting firm. I was in the audit division. So I was doing audits of like big corporations and private companies. And I'm just like, I looked at the person sitting across from me who was 10 years, older, 10 years more deeper in their career. And I'm like, this is not where I want to be, right? I'm like, this is not who I want to be in 10 years from now. So that's kind of what continued that fire to go into the real estate investing way. And then at some point, I'm like, how can I just put these two together? Because I had done a brief stint in recruiting. I thought at the time that recruiting would help me build this big network people who would eventually invest with me. Probably that's not really how it worked. And so by the time I got done with recruiting, I'm like, I want to go back into the accounting field. I want to do tax, small business type of stuff. And that's when I really realized, I'm like, I should just marry these two together, right? I should just take my passion for real estate investing and just go help real estate investors reduce tax. And it was interesting, when I was in recruiting, I seen a lot of people actually do a lot of tax planning, a lot of career opportunities in that. So I guess that all kind of brought it together. My passion for real estate, the fact that I had an accounting background, I'm like, let me just do this. Let me just help real estate investors.
And how long have you been? I mean, are you guessing? I guess you call yourself a CPA. I'm guessing, correct?
Yeah. So I've been a CPA for almost 10 years now, but I've been doing tax advisory for about a little over 6.
Okay.
So
But when you're sitting there auditing stuff and probably at a high level and that, you're learning a lot real fast, I'm guessing.
oh yeah, yeah. When in auditing was interesting because I worked for such a big firm. I only saw a very small portion of the audit and not the entire picture. Like if you worked at a smaller accounting firm, you see more. But working here where I'm at now, I see a lot. Like I've worked with a lot of different real estate investors. People have like as little as one rental property all the way up to like dozens and dozens and syndicates and funds. So here I've seen a lot of different stuff on tax returns. I've seen a lot of different ways on how people get into the field or get into real estate investing in the first place. And most of the time people have either a business that they're running and they have capital to go put into real estate, or they have a job, typically a high income job for the most part, because that's what allows you to have the discretionary income to ultimately fund these real estate investments. So really what I've seen, most people have some kind of primary income generator or PIG, sometimes people call it, and then they pour that money into real estate. And even if they are in real estate full time, they still have a primary income generator. That income generator might be fixing, flipping properties, or wholesaling properties, or are syndicating, and they're using the fees from the syndication. So, or they're an agent. So that's how I've seen it go from my experience. But I've been fortunate to see a lot of different things.
Yeah, and some from my side, it's pretty interesting. I do residential financing. My wife does commercial. We work with a lot of real estate investors, and I happen to meet a lot of new ones that want to get in the game. And it's kind of funny because a lot of people that are getting into real estate, a lot of the conversation, it's for two reasons, right? Number one is like, hey, I want to go build a portfolio and I want to, quit this job, right? The other one is kind of like a doctor, I'm an attorney, I'm an entrepreneur, I'm having big income, and I went to my CPA and I'm like, I'm just getting hammered in taxes. And I always say, hey, I appreciate you paying all those taxes for us. We do appreciate that, and they're just like, he's like, here's your options. You got to buy real estate. So the first step for a lot of them is just like you said, I've built up some cash. I'm tired of paying the taxes. And how do I reduce that? Right. And then a lot of these guys, whether they're going to meetups, reading books, partnering up with people, right? That's the opportunity. So I'm guessing for you, because that's where I wanted to start the conversation when it comes to like getting more technical into this stuff, is that a lot of people are calling you and saying, hey, Thomas, how can I reduce taxes, right? What do we got? And then I think a lot of people look and they're like, man, real estate really is one of the highest on the bar. And so I wanted to ask you, is this a lot of conversations you're dealing with, like even before even people buy real estate?
Yeah. So most of the people come to us typically who become clients of ours typically already own real estate, but we have a lot of people in our community, like our Facebook community, who are just getting started. And that's one of the big things that they're looking for is how can I use a real estate to reduce tax? And I could break it down. There's really, let me break it down like this. So if you have a job or you're running a business, you're usually going to pay tax at the federal tax rates of up to 37%. On top of that, you're usually going to have state tax. And if you live in a state like New York or California, high tax rates. It's pretty painful. And then you also have FICA. So if you have a job, you have a FICA tax. So it's 7.75% up to a certain amount. And then if you're self-employed, you get the privilege of paying double. So you get to pay 15.3%. So you can easily see if you're a high income earner going up to 40 to 50% in your taxes. And I've seen this happen, especially people in New York and California. So what people start to do is like, they look at the real estate, like you mentioned, how can I use real estate to reduce my tax burden? So I'll break it down if you're going to do it like part-time or passively, how that looks like, how that can help you reduce taxes, if you're going to do it full-time or you're going to do it on a more active basis. Okay. So the first thing is, when you're investing in real estate, well, the rental real estate, that's also taxed at that 37% rate. You're not going to get taxed at that. You're not going to have FICA on it for the most part, or self-employment tax, but still taxed at 37%. The difference is that with real estate, you have a non-cash expense called depreciation that basically shelters your rental income from tax. So what you'll see in many cases is you'll have a property that might have positive cash flow. So you're putting money in your pocket, but you're telling the IRS that you have a loss. So you're saying, hey, IRS, I lost money. So you're not paying taxes on that cash flow that you're generating. So just by being in rental real estate in and of itself, whether you're investing in a single family home, a multifamily property, or you're doing like a syndicate or fund that you're putting in really passively, you're already putting yourself in a good position to shelter that income. Additionally, when you go to sell that property, you could defer the capital gains tax, which is taxed at a lower rate, but you could defer the capital gains tax via 1031 exchanges, Or you can do things like buy another rental property in the same year and then use the losses generated by depreciation from that rental property to offset the gains on sale from the property you sold. So really, that's available to anybody who's investing in rental real estate. So that's kind of the first step. It's like, okay, you're building tax advantaged income. So I don't know. I know I just kind of threw out a lot right there. Should I stop or should I just go
No,
right
that's
into it?
good. So let's dive into that. So basically, what you're talking about is somebody that's you run a business, you have a job, and you're doing this kind of a part-time thing on the side. You're buying some rental property,
Right.
and then that's kind of what the advantage you can take advantage of. And then you're probably going to go into next somebody that's classified as a, real estate professional, real estate investor. I forget the exact terminology, the IRS code. Is that what next you're going to dive into that person?
Yeah, yep, absolutely.
Because there is a lot of confusion here, right? Because people call me and they go, look, I'm not a CPA. You got to talk to your CPA, but people are kind of like, there's this bucket and there's this bucket. How do I get into this bucket? And I said, I can't, you got to talk to your CPA, but this is the bucket that everybody wants to be in, right? Because this is where you can really take advantage. And so I think it'd be nice when you talk about the first bucket, guys, just so you're going back to, because I think a lot of people are going to look, this is somebody that's like, I'm buying, but you're not a true professional real estate investor or full-time, and you cannot take the full advantage of all the taxes. What we're going to go do next is how do you become a professional full-time real estate investor? What are the requirements? How does that look like? And I think a lot of people are kind of like, on the fine line, and how aggressive can you be with it? So if you can dive into as much as this one, I think this is where people really are fascinated.
Yeah, absolutely. I could dive deep into that. So just kind of like to leave off where we just were, right? So anybody who's investing in real estate, even if you're passive, you're able to shelter your income from your rental income from tax. That's great. Now you might have this loss. Now the question is, well, what happens to this loss? Well, if you're on that passive part-time side, that loss you can't use to offset your W-2 or your active business income, also known as non-passive income. That loss would be suspended and carried forward to you to future years where you can use it against perhaps to use it to reduce future rental income or gains from the sale of property. But if you are a real estate professional, you can use these losses to offset your active income. Now, to qualify as a real estate, you spend more than 750 hours and half your total working time in a real property trade or business. So basically, for effectively, you need to be working full time in real estate. Now, if you have a high income job that's not real estate, or you're running a business that's not real estate, like what's common for like doctors, attorneys, people who are like in sales and stuff like that, unfortunately, it's going to be very challenging, if not impossible, for you to qualify, because there's been so many people who've tried, and the tax courts and the IRS will stop you from doing it if you have a W-2 job, because these rules were put in place to stop people who are in that position from doing that. So if you can't go into real estate full time, well, what can you do? Right? That's the next question.
Yeah.
So you can have your spouse qualify. So we see a lot of times we'll have one spouse who's a high income earner. Maybe they're running a business, or they have a job that's a high income job, but then they have a spouse who's working maybe part time or not at all. If they can run the real estate portfolio, if they can qualify as a real estate professional, then they're able to, because they're married, if they're filing a joint return, now they both benefit from that real estate professional status. So you can take the losses from your rental properties and then use it to offset the income that you're earning from these high income jobs or businesses, and pay significantly less taxes. So that's the real estate professional status. And again, we've seen a lot of successful couples do that in that scenario, or people who are just full-time in real estate. Now, there's one more thing that you can do. So there's something called the short-term rental loophole. So with this, the only way to really use your rental losses is to qualify as a real estate professional. But there's an exception to the definition, and that's because, let me just back this up real quick. There's in the tax code, all rental activities are passive by default unless you qualify as a real estate professional. So that's kind of why the real estate professional status exists, to get around that rule. But there's an exception to the definition of rental activity in the tax code if you have an average period of customer use of 7 days or less. So if you're investing as a short-term rental, your rental property, if it has an average stay of 7 days or less, is no longer passive by default, and instead is treated like any regular business. And at that point, if you're materially participating in that business, then those losses would be non-passive. Now, the bar to materially participate is much lower. There's 7 different tests, and all you need to do is meet one of these tests in order to show that you're materially participating. And I'm not going to all 7. There's 3 that really matter for most people. And the first one's going to be you spend more than 500 hours on the property for the year. The second one's going to be you do substantially everything. So effectively, you're a one-person show. And the third one is you spend more than 100 hours and no one else spends more time than you. So if you have a short-term rental property that has an average period of customer use of 7 days or less, and then you materially participate, then boom, you can use the losses to offset these other forms of income. And you don't need to spend more than half your total working time. So this is a great alternative. And one more thing that I'll...
That's cool. I didn't know that. I learned something new today.
This is actually a really popular strategy amongst like high-income earners. Doctors love this right now because you don't need to spend more than half your total working time. Additionally, just to kind of back this up a little bit, to qualify as a real estate professional, one spouse must spend that 750 hours and more than half the total working time. You can't combine hours. So if spouse B spent 50 hours working on the rental property and spouse B spent 700, neither of them qualify because neither one of them met 750. With the short-term rental loophole, both spouses' time counts towards those material participation tests. So you can have spouse A spend 51 hours, spouse B spend 51 hours, 102 hours. You met them more than 100 hours. And as long as no one other person outside of you and your spouse is spending more time than you, then you're good.
Wow, that was cool. Okay. I always make a little joke here. So I'll get introduced to a doctor, entrepreneur, or, attorney. And they go, hey, I want to take advantage of this. I said, well, you're not going to be able to. I said, but are you married by any chance? They go, yeah. Does your wife have a job? She goes, no. I go, well, she has one now. What? I said, she's a property manager. He goes, excuse me? She doesn't want a job. I said, she's going to want that job if you're going to want the taxes. So yeah. I literally had a wife go, excuse me, what is this going on? Like you said I had a job. She got all mad. I go, look, I'm just, it's a joke, but it's kind of like, this is the option. So I want to back up and just go through these. So option number 1 was the part-time investor, where really the only thing that you can take advantage of that is to offset actual rental income.
Right.
Okay. The second one, which is the big one, is the full-time real estate investor, let's call you, where you need to be 750 hours, whether management, looking at deals, whatever. It could be a whole list of things that you can do. That is something that should be logged, because if you get audited, you're going to need to show that to, the IRS. Right. So you need to log that down. And then those people can offset W-2 income, K-1 income, stuff like that. Does that max out at $500,000 W-2 income, right? You can't.
Yeah, so there's something called the excess business loss limitations, and that says that you can't deduct more than, and this is indexed for inflation. So I think in 2024, where we currently at, I'm actually going to look up the number. It's higher than 500K, but yes, there is a cap on the amount that you can deduct if you have from using your losses. If you have a W-2 job, if you have an active business, if you're running a business, a little bit different because the excess business loss limits don't apply. But if you have a W-2 job, then there is a cap. And that cap for 2024, if you're married, is $610,000, and it's $305,000 if you're single. So
Okay. Which is huge. And then option number 3, which I've never heard of, is basically if you have a short-term rental, which the IRS looks at more of running a business rather than, because it's almost like a hotel. That's basically how they probably almost, right? I mean, you have something that's You're turning and burning 2, 3, 4 days. It's more of a business, which it is really. It's run like a business, and that they look at that completely different. So you could take advantage of that. And if you have 10 vacation rentals and you're running them and your wife, you could also take advantage. You and your wife can work it together, like you said, and you can actually have losses off of your income earned for that year.
No, exactly. You described it exactly how it is for, because it was intended for hotels. But, at the end of the day, when they wrote these rules in the 80s and 90s, they didn't foresee Airbnb becoming what it was. So, but now those same rules, though, apply to the short-term rental, like single family houses, condos, townhouses, all that.
Yeah, and it makes sense because it is like running a business. It's pretty much, you cannot say it's not. I mean, like you got the stuff. So the other thing is so for option 2 and then option 3, I know you could do this on option 1, but option 2 and 3, there is a thing which is surprisingly, we would think a lot of people know this term, and they might know this term. And I've met real estate investors that literally just learned this 3 years ago and never used it is a thing called cost segregation, right?
Right.
And
Right.
it blows my mind how people are like, wait a minute, you never knew about cost segregation? No, I'm like, how, and you're this big of it, and how is that possible? I don't know. So if you could kind of talk about, because I know there was like the bonus depreciation that Trump came out and you could accelerate it. You know a lot more than this about me. Can you talk about what exactly is cost segregation? And then how does this work? How does this get applied? And then also, I think there's like the bonus depreciation one where you could take it up front, but I think that's kind of sunsetting, and I might be speaking out of tone here. I think there's like so if you can kind of go into what that is, because I do that. We do that, my wife and I, which is amazing. You can wipe your income and keep growing, but a lot of people don't understand how that works. And I'm not as intelligent and wise enough as you to explain it. So I'm sure you can explain it better than I do.
Oh yeah, no, absolutely. I'm happy to break that down. So this is what makes cost segregation. That's what makes these things. That's what makes the real estate professional status and the short-term rental loophole so powerful. Because let me start here. If you have, say, a single-family house, it's a residential house. Let's just say you're renting out a 12-month lease standard. Let's just say it's $500,000, and usually, so land's never depreciated. So let's just assume that 80% of it is the actual building itself. That's $400K. Now, that would be depreciated over 27 and a half years using regular straight line depreciation. So that would be $14,545 roughly per year you're getting in a depreciation expense. It's nice, but with bonus depreciation, what cost segregation does. Okay. Cost segregation, what happens is an engineer comes to your property and says, look, your house is more than just the structure. There's more components in there. Those components have a lower class life than 27 and a half years. If for real estate, it's somewhere between 5 to 15 years. And the cost segregation study breaks down the components of your property into that 5. There's something called 7-year property, 7 and 15, and then 27 and a half year property. Now, usually somewhere between 20 to 30% of that building value can be reallocated into this 5, 7, and 15-year class life. So this $400,000 building that we're talking about here, let's just say it's 25% for the sake of splitting it down the middle, right? That's $100K. That's $100,000. Now there's something called bonus depreciation, which has been popular. It's been extended thanks to the Tax Cuts and Jobs Act. And if you bought a property from the tail end of 2017 all the way through December 31st of 2022, and I know that's a year or so removed now, you had 100% bonus depreciation. I'll circle back on that in a second because I might have good news. But that started to phase out 20% per year starting in 2023.
That's what it was. Okay, cool.
So in 2023, it was 80% bonus depreciation. Where we sit today in 2024, as of this recording, it's 60% bonus depreciation. And it's going to phase out to 40% in 2025, 20% in 2026, and then it's gone under current law in 2027. Now, I don't want to get people's hopes up, but there's a bill that's on right now as we speak here in January 2024 that's on the table. Congress is trying to pass it before the 29th of January, which is when tax season officially starts and you can start filing tax returns, to bring depreciation back, to bring 100% bonus depreciation back through 2025, through the end of 2025. So in other words, 2023, 2024, and 2025 would all see 100%. So if we just go back to our $100,000, right? So we had the $500,000 property, $400,000 of the building. We went ahead, we called up the cost seg company. They came and did the cost segregation, and they said $100,000 is in this 5, 7, and 15-year bucket. Well, that's all eligible for bonus depreciation. So if we look at it as it stands today in the law, you're at 60%. So now you're getting a $60,000 reduction in the first year that you buy the property, which is pretty powerful. $60,000, that's usually going to cause a sizable loss on paper, a non-cash loss that you can then use to offset your income. So let's just say, for example, that for the sake of it, just say that your loss ended up being $60,000 and the rest of your income got offset by the expenses of the property, for the sake of argument. Then if you're at the 37% tax bracket at the federal level, that $60,000 deduction is worth $22,200 in tax savings. Now, let's just say that 100% bonus depreciation gets restored or gets extended. Now you're going to have a $100,000 deduction from this bonus depreciation. Very powerful. The 37% tax bracket, $37,000 in tax savings. So this is powerful. It's a game changer. And the one thing I want to say about cost segs, we're on it, if people don't know, is
you don't just have to go pay for a report, you get it. You can get a firm, they'll give you an estimate, right, of what they think the savings is before you pay them, at least the one I go. Then you could give it to, your CPA or something like Thomas. He can look at it and say, hey, if you actually pay for this report, $5,000, $10,000, whatever, we're going to be able to save you this much. So you can tell them at this point, it's pretty much free. And then it's like, pull the trigger, pay the money. And you're already telling them, hey, if this is what it is, this is what you're going to save. It usually is a no-brainer for everybody, for sure. So,
yeah. Oh yeah, no, for sure. If you can qualify as a real estate professional or use the short-term rental loophole, cost segregation studies in general, even on properties, we've seen them done because there's something called a software study where you'll put information into a software and it will give you the report. So it skips the engineer coming to your property. And that works on smaller properties because it's A, lower risk, and B, it's easier for them to use like algorithms and data and stuff to extrapolate that. So what I'm trying to say here is that we've seen these things be done on properties like small as $150,000 of a purchase price. And if you have the real estate professional status or the short-term rental loophole, it's a no-brainer. Having said that, it could still be powerful if you're in that first bucket from before, that passive bucket, because if you do a cost segregation study on a property that you own, those losses can be used sometimes to offset a property you might be selling in the same year. So while it's usually a no-brainer if you're in those other two buckets, if you're in the first bucket, it can also make sense under certain circumstances.
Yeah. Couple things I want to clarify too with you. So if you put money in a syndication, you probably know where I'm going with this, and you get a K1, and most of the time it's probably negative. So you're like, sweet. Sometimes I have to actually go to that syndicator. Maybe you own 10% or 20 and get the return because it's negative. I'm like, no, it's not negative. I got to get the depreciation add back for the underwriter to say, no, you got to add it back. But with that being said, people will get, and sometimes there's just things on the internet, and I think some people are misunderstanding. In order to take that loss again off of income, you still would have to be full-time real estate investor to take it, just like it's the same, right? Like you can't, if you're a W-2 employee, you get the loss, you can't take it off your income. It's going to be the same thing as being like a active investor or not, right?
Right. So if you get so this is really interesting with the syndicates, right? So you get the K1, you're basically, if you're a limited partner, you're basically, it's passive. So it's going to be passive. It's like being in that first bucket we're talking about. However, the way you can actually turn those losses non-passive under a very narrow strategy. So that is, you would qualify as a real estate professional. Now, you would have your own portfolio that you're self-managing. And then from there, you make what's known as a grouping election. It's a tax election. It's called the -9 election. We're getting deep into the technical tax code here. But now you treat all of your rental activities as one. And if you're a real estate professional and you spend more than 500 hours self-managing your own properties that you own, now all your rentals are treated as one, and these LP investments are now non-passive as well. But barring that very limited exception there, those losses from those K1s, unless you're like the general partner putting those deals together and making that deal happen, those losses are going to be passive for you.
Okay, cool. I just wanted to verify that. Okay, so I got a couple. These are some quick questions that I see people making mistakes, and maybe you can clarify. So if somebody calls you and they say, hey, Thomas, I got a property I'm going to buy, or a real estate portfolio. Should I vest them in an LLC or an S corp? And I've seen both, right? I've seen both. I've actually seen somebody do it in a C corp, and I was like, what? And so I just say, hey, who told you to put in an S corp? They go, this. I said, what do you think? I said, I want to get a second opinion. So that's my opinion on it. Yeah. I haven't had anybody say do it in an S corp. So LLC or S corp, can you explain why you would not put one? We're just talking properties, not a business, guys, just properties. Yeah. Why you'd put one over the other, or why you would use both, or maybe you don't use one at all.
Yeah, right. That's a great question. So let me clear the air and hopefully help some people out there. Don't put rental properties in the S corporation. Don't put a rental property in S corporation. And I'll tell you why. S corporations are separate entities from you, legally. And what that means is because they're a corporation, if you put a rental property in there and then you have to remove it at some point, and there's a lot of reasons why people have to remove it, perhaps for financing, perhaps for estate planning, for perhaps you're restructuring or your situation changed and now you need to restructure your assets for asset protection purposes. If you remove that property from the S corporation, it's treated like a sale. It's treated like a sale. even though you might be transferring it to another entity you own 100% of. So you could own 100% of S Corporation A.
I've never heard that. I've never heard that. That's painful. That could be painful.
I've seen people have 6-figure tax liabilities, almost 7-figure tax liabilities, like the taxes they'd have to pay to get this property out. And there's no real good way to get it out without and avoid that tax liability. So the way you avoid it is by not putting a property in an S corporation to begin with. The second reason, and this is kind of getting a little bit into the weeds here, is there's something called basis in the S corporation, which is usually your capital contribution, so the amount of money you put in the S corporation, plus your income and capital gain, and so on and so forth. With S corporations, and there's something called QNR, which is qualified non-recourse debt. So if you have a partnership, qualified non-recourse debt, the amount you sign the loan for will give you basis in the partnership. And that allows you to take losses out of the partnership. So if you have this big loss from the cost segregation study, everything we just talked about, during that QNR, the qualified non-recourse debt will allow you to take those losses out of the partnership. That doesn't exist for an S corporation. The QNR does not exist. So your losses might be trapped in the S corporation and not flow onto your personal return. You might not be able to use them. So that's the second reason. Now, before everybody panics, if you do have a rental property in S corporation, rental property right now, it's not the end of the world. It's just not ideal. And if you ever do need to remove it and you're not selling it to a third party, you might run into that issue. So typically the appropriate entity for a rental property, at least from a tax perspective, is going to be a single member LLC. If you're the only owner, that would be disregarded for tax purposes, which means it goes directly on your 1040. And you can remove a property from a single member LLC relatively easily with no issues. If you're going to have multiple owners, like if me and you were to partner up, for example, we'd want a multi-member LLC tax as a partnership.
We'd file the LLC return and we'd actually file, right? Or you still could split it up, put on your 1040 or...
Right. So when you have an LLC tax as a partnership or a multi-member LLC, it's by default tax as a partnership. You have to file a separate tax return. So Form 1065. So that's like that's why I guess one of the quote unquote downsides of a multi-member LLC. But if you're doing it with multiple people, it's kind of a necessary thing to do. So
on the LLC, the S corp, I was reading something, probably about this, starting January 2024. If you do start an LLC, you have a corp, you have 30 days to fill out, you have to fill it out and basically tell basically the government who you are.
Yeah, so something called the Corporate Transparency Act. And what that does is you have to file what's known as a BOI report, a beneficial owner report, which tells the FinCEN, which is basically part of the US Treasury, who owns the property. Who owns the entity. So you have to tell them like your name, your address, like you have to valid IDs and all this. Basically, you're telling them everything about you, long story short. And that you have, if you start an entity this year, I think it's 30 days, but I think they might extend it to 90 days.
Okay.
If you're listening to this, go look it up before.
30 days seem fast to me. I'm like, wow, it's fast. Yeah.
Yeah, no, it is pretty fast. And I think they extended it to 90 days, but they're changing the rules like seemingly every time you turn around. So if you're listening to this, go just Google it for the latest updates. But they're making it pretty quick. Now, if you have an existing entity prior to this year, 2024, you have a whole year. You have until next year. You have until like basically the end of this year to do it. So you do have some time for existing entities, which makes sense because if you think about it, someone who has this vast structure of entities, there's a lot of work. And the part that's confusing for a lot of people about the Corporate Transparency Act is who's going to help you file these reports. Now, it's ultimately on the owner of the entity to do it, to make sure it happens, but it's going to be the attorney or the CPA. So like the AICPA and insurance companies are telling CPAs, like, we're not going to cover you if you do this because it's an unauthorized practice of law. So you have all these people who think their CPA is going to help do it. But I've been doing a lot of research on this, and it appears my early research, that they're developing solutions to help attorneys do this in mass. So this is all this to say, there's probably something your attorney is going to be helping you with, and you should probably seek guidance from your attorney on the Corporate Transparency Act. But it's really important to know that's out there.
Yeah, another exciting, fun thing to paperwork to do. So I kind of wanted to. I'm going to definitely throw some people under the bus here, but I think people need to know, guys, we went through 3 ways that save tax strategy. And I do, like I said, I've done a lot of loans, and believe it or not, I see people do this, and I'm kind of like going, you do realize that you could get audited, and you do realize if you get audited, they can just verify things easily. So people think instead of getting a CPA and talking about strategies that save money. Well, why don't we just not claim all the income? Why don't we just write off stuff that I didn't even do, right?
Yeah.
There's people I've seen form an entity that doesn't even really earn any income and they just have a bunch of losses. And I'm like, did you actually have these losses? No. And I'm like, what happens when the IRS asks you for all the paperwork? They're like, shit. Yeah, it's a good question. So to you, Thomas, and I know you wouldn't recommend this, but people that are like, I'm not going to claim all the rental income because then it'll show less income, I'll pay less taxes, or hey, I'm going to write off all this crap just to zero it out. We went through 3 strategies, but can you just explain to people like why they should just not do this? And maybe they've never been through an audit, which I'm sure you know what that's like, is what kind of trouble they can get into, and that's your CPA. Some people are like, their CPA knows this. I'm like, what? So I'm just kind of venting to you because I'm like, I literally see this and it blows my mind. Like, I cannot believe people do this, but you probably see a lot of crazy stuff.
Yeah, we've seen a lot of shady stuff be done by people. But yeah, so you don't want to do that. You want to report the income that you're making, okay, to the IRS. You want to report your legitimate expenses. And to do that, you want to have good books and records. So if you're running a business, you want to have good bookkeeping and you want to keep your receipts and you want to keep everything nice and tidy, because here's the thing, while audit rates are pretty low, when they come and they start to look into things and you don't have everything together, it gets painful really fast, right? You have to try to pull everything together really quickly because they give you deadlines and stuff, and it can just get messy and painful. So that's if you're doing everything legitimately. So you want to have bookkeeping and you want to report everything correctly. Now, if you're lying and you're making stuff up and stuff's just not happening, you're not going to be able to pull that substantiation together at all because it doesn't exist. And the IRS is going to basically, you're going to lose the audit. You're going to have back taxes, pay the taxes you should have paid, penalties and interest. And interest is pretty high these days. I think the AFR rates, which is what they charge basically, is around 6%. So it's not, and that could be 2, 3, 4 years down the line. So don't do that. Just don't do it. Pay your taxes, report it correctly. Don't create phantom entities. Don't report expenses that don't exist. Don't underreport your income, because it can put you in a lot of trouble. I don't think you're gonna go to jail for the most part, but you're gonna have to pay back taxes, penalties, and interest, and it is painful. It's painful.
Yeah, and also you're saving in the short run, but if you get in trouble, it's gonna cost you a lot. You're screwed. It could put you in a really bad financial spot.
Yeah. It's not only you're gonna have to come up with the money to pay them, right? Which you may not have at that point, but it's a hassle to go through these things. Like if you get an audit, if you get a notice, the first thing you should do when you get that notice, promptly contact your CPA, because you don't want to go it alone. Because if you start providing if you start going it alone, you start providing the IRS information, you might be providing them too much information. You might be providing them too little information, or the wrong information, and then you can lose. Like we've had so many people come to us in the middle of audits when they're like, we need help. And it's like, it's already too late. You already
dug your hole. Yeah. Like it's like,
it's crazy. And then, on top of that, when we have people who they'll get the notice will say you need to respond by January 25th. And they'll come to you on January 21st. Like, oh my God, I need help. Like it's a fire. And it's like, so when you get the notice, call your CPA, email them, whatever you got to do. And just start working through that process, because you want to do it right. You want to get it right the first time to maximize your chances of winning that audit and coming out the other side in a favorable position.
Okay, cool. Thanks for clarifying that. I think that's good.
We've been working on this for the past few months.
You know, we always want to bring as much value as we possibly can. And our partner, Prime Corporate Services, is all about bringing you a service you can't get anywhere else at a price you can't get anywhere else. Whether you're new to owning a business or owning a property, or you're an experienced property owner or investor, Prime Corporate Services is not only going to help you, but they're going to make the process so much easier. So if you book a call, the first thing they're going to do for you is help you understand what your business structure should look like, your corporate structure, tax planning, estate planning, all of that. Maybe you're saying, I'm brand new to starting a business and all this sounds foreign and complicated. Remember, this company helps new people just getting started every day. They're going to help you form the entity that's best for you and walk you through the process. Before I found this company, we paid thousands of dollars to other attorneys, CPAs, and consultants to try to understand exactly how we need to be structured to be as protected as possible. We've also gone the other route and used online platforms to form entities which unnecessarily put us at risk. You guys, you don't have to do that with this company. They'll do all of these things for you at a reasonable price, so you never have to think about saving money at the expense of exposing yourself to liability. We've searched high and low, and you will not find this much value anywhere else. All you have to do is schedule a free call today. Just go to primecorporateservices.info/GITCG. Once again, that's primecorporateservices.info/GITCG. We'll also leave the info for you in the show notes.
Couple questions for you here that I would be interesting to see your answer. You're going to sell your primary residence. You're here in California and you get, I know they're trying to change the laws to, 500 single, a million, whatever, to get people to sell. You're going to sell a home and you're going to net $2 million. So you're going to pay the piper. A lot of people come to me and go, "Hey, Kenny, do you know like how I figure out my basis and it's CPA?" If you kind of break down, I don't care if somebody's making 100,000 over or, $1 million. Is there anything that anybody should be thinking about? They should be knowing that, hey, when you have your capital gains and your primary, you can go back and we can write off this. You can look at this. Is there anything you can do to reduce that just in general? Maybe like you mentioned, hey, you've had a couple of rental properties. You haven't just built up this negative, right? This cost loss carry forward built up that you can't use because you're not a professional real estate investor. Could you use that? I'm just trying to think because a lot of people do pay capital gains and I get the call and I'm kind of like, I don't really know this stuff that well. And that's why I figured I'd ask you because, you probably get these questions.
Yeah, absolutely. So let me start here. So when you have a residence, it's a personal asset. So the losses that we're talking about throughout this show cannot offset the gains from the sale of that residence because those are business losses.
Gotcha.
Whereas this is a personal asset, so they can't cross over. However, there's something called the home sale exclusion, also known as Section 121. And what that does is says that if you live in your property for live in your residence for the last 2 out of 5 years, if you're single, you can exclude up to $250,000 of capital gains from taxes. And if you're married, it's $500,000. And that is the one way you kind of save on taxes when you have a residence, and that goes for your primary residence. So you have to live in there for the last 2 out of 5 years. It does not have to be consecutive, but it has to be 2 out of the last 5 years, and you're eligible for that exclusion. And there's exceptions and nuances that allow you to get partial exclusions if you didn't live in it for 2 out of 5 years for certain exceptions. But that's kind of for people who are thinking about selling their home, that is kind of the saving grace for a lot of people is that home sales exclusion.
And then if you bought a home, let's say we'll pick numbers. You bought a home for $500,000. You went and dumped $250,000 into it, and then you sold it 5 years later for $2 million.
Yeah.
The $250,000 you put in, would that come off the gain?
Yeah. Long story short, yeah. So that $250,000, assuming it was capital gains, like say, for example, capital improvements, like say, for example, you put a pool into the home or you redid the roof or you expanded the home in some way, stuff like that, that would be added to your basis. So let's say you bought the home for $500K, right? And then you put the $250K in of capital improvements. Well, now your basis is $750. So when you go and sell that home, if you sold it for $1 million, you're no longer selling. It's no longer $1 million less the $500K. It's going to be $1 million less the $750, which reduces the amount of capital gain you're going to have. And of course, the selling expenses, things like that go into it. But ballpark numbers, you want to keep those receipts, you want to keep those invoices, you want to keep the scope of work from doing all that work to your property because it can add to your basis and reduce the capital gain and potentially reduce the amount of capital gains tax you have to pay, assuming you're not covered by that home sale exclusion.
And here's something I get a lot. I do get a lot of calls of people that are not happy with their accountant CPA, right?
Yeah.
And I think the big challenge is they feel like they're not an advisor to them. They feel like, Kenny, I've got to call, I got to pull the questions out of them. I've got to say this. I'm not getting advised. I don't feel like this person understands real estate. I don't feel like I'm a business owner. They're doing me justice. Could you just kind of, to that person that might have a CPA they're not happy with, because obviously this is a passion for you. You're here doing a podcast about it. You do content about it. So it has to be a passion, right? To do that stuff because it's your time.
Yeah.
Can you just talk about really that there might be differences or kind of like with your service, are you more of an advisor? Should your CPA be more of an advisor? Should they be a little bit more proactive? Or is it not, that's not the norm? Like there's just this big confusion. And I think people really, it would be cool to hear from a CPA's perspective on that, because my thing is I'm a loan officer, but I'm more of an advisor to people this part of my career. Right. And that's how I feel. And they feel that, especially if you have a financial guy, you have a financial advisor, it's in the name and the guy never advises you. It's kind of like, well, maybe you have the wrong guy, but I don't know if that's expectations we should have for CPAs?
Right. So there's a lot to unpack here, but I'll make it brief. So most CPAs are tax preparers, especially tax accountants. They prepare your tax returns. So you go to them during, the first quarter of the year, during tax season, you give them your information. They go ahead and file your tax returns and they say, we'll see you next year. That's what they do. They take on so much tax work throughout the year. They don't have time to help advise you. That's not how they make money. The second thing on that, most CPAs are introverts. So they'd rather sit behind the computer, and they would not be doing something like this or getting on the phone with you and having a consultative discussion of, okay, hey, what do you have going on? What's your situation? What are your goals? Okay, here's what you can do. So most CPAs don't do that by the virtue of that their business model is prepare tax returns, and that's what they do. They don't have the skill set to do it either. And for that reason, a lot of people get frustrated. They go to their CPA and expecting their CPA to tell them what they could do to reduce taxes, but that's not the business model. Another reason is that most CPAs are also generalists. So what does that mean? They focus on a lot of different things and they never go really deep into any one. And real estate, there's a lot of nuances and a lot of different things that are part of the tax code for real estate investors that most CPAs aren't aware of, or because they don't go deep, they're not comfortable, advising on. So a combination of those things to what you see. So what you want to be doing is you want to be looking for a CPA or CPA firm that does tax advisory, or sometimes they're called tax strategists, where they're going to sit down with you and they're going to say, okay, well, where are you today? Okay, so what do you have going on today? What are your assets? What are your income streams? What are your goals for the future? Okay, you want to buy properties. You want to expand your portfolio here. You want to start this business. Okay, well, what can we help you? What can we put in place? What strategies can you use? Maybe it's the real estate professional status. Maybe it's the short-term rental loophole. What can you use along that way to help you reduce taxes? And then give you a plan to help you do that. And not all CPAs do that. There's not that many so you need to go out there, you need to find someone who could help you with that. And you're not going to see that frustration. But if you go to your CPA down the block, or you go to your typical CPA and expecting that service from them, you might be disappointed because chances are they probably do not provide it. And I'm not trying to knock any CPAs out there. This is just the reality of the world that we live in right now.
Yeah, it sounds like basically what you're saying is CPAs are busy doing taxes and they don't have much time to advise. And if you really need to be advised, you need that, then you need to make sure you partner up with that right person. And that person might cost more money, because it's not just about you're paying somebody to file your return, you're paying somebody to file a return and advise you. So you're going to need more time, energy from somebody, which might cost more money. So that's another factor. You can't expect to pay somebody the same fee and advise you, because but you kind of pay for what you get.
Yeah, and that's really interesting that you brought that up, because it's like kind of a double-edged sword. It's like people, and we've seen this happen before too. It's like people want that service, and then when you tell them, okay, well, we can help you with that, but it's not going to be at the cost of your tax return. There's an additional charge for something like that. They're like, oh, well, why isn't just included? So it's just interesting. So it's like, it's basically two separate services that you're getting provided. One of them is like a strategic advisory planning service. The other one's a tax preparation services. Two different things. And one of them is to file your tax return so you remain in compliance with the IRS. And it's important because now you get to capture the benefits from the planning that you've done, the consulting that you've done. But to your point, yeah, people get confused or like, wow, I have to pay more money for that. But yeah, it's a different service. So
is there any, how do I say this? Is there any do not do this? Because you're probably is there anything that really would just trigger an audit? Like that's like, just do not do, like maybe 2 or 3 things. It's like, for goodness sakes, do not do this, because you're going to get, like some people say, when you amend your tax return, it raises a red flag for an audit, or, I hear things like that because I'm in the lending world, right? So I'm probably asking you a lot of questions because you can see I'm hearing this stuff and I'm around this, but underwriters don't even like amended returns because like, oh, you just amended and showed more income to get the loan. It's like, well, no, somebody messed up and we have to some people make you wait a period until you refile. But is there anything like glaring that's like, do not do this, you're going to get, and yourself in trouble or an audit?
Yeah. One of the big things is probably claiming the real estate professional status when you don't qualify or you have a full-time W-2 job. That's almost like, it's like what someone once I heard them say is easy pickings for the IRS. you're probably going to get, I don't want to say probably, there's a good chance you might get audited when you do that. That's a major red flag, claiming a real estate professional status when you have a full-time job. Now and you're not doing it correctly. And it's tempting because if you file your own tax returns, right, you go on TurboTax, you click the little button, the real estate professional status button, boom, your tax liability just drops. And you're like, wow, look at that. Just click. But it's really easy to do to file it that way. But if you can't substantiate it, don't do it. And we see this happen all the time. In fact, real estate professional audits probably one of the biggest audits we see. And those are the people I was talking about before who come to us in the middle of the audits and they've already lost because they never qualified to begin with. So that's one of the biggest red flags. As for amended returns, so when you amend a return, it's usually reviewed by somebody at the IRS. So when you go ahead and you file your returns electronically filed for the most part, or even if you mail it in, they scan it, and it's a kind of an automated process. And you could still get audited from that happening, but if someone's actually looking at your return, now they're like, you know what I mean? Like, you ever seen that meme? Interesting.
Yeah.
Like, what is this?
Yeah.
And so, yeah, I mean, there's nothing wrong with amending. Sometimes amendments are important. Sometimes you could save a lot of money by amending, or sometimes something was actually done wrong and you have to correct it. So I don't want to discourage amendments, but just be aware that sometimes it's best to get it done right the first time, because if you have to amend it, you're putting a set of eyes on it that you may be better off not having. So, I mean, it's hard to say like big red flag things outside of being fraudulent, but the real estate professional status doing that erroneously is probably the biggest thing.
Well, last tax question, and then I wanted to get into just a little bit of chat about the real estate investing, and then we can wrap up. So I just thought of this one. I was like, okay, I got to ask you this one. So 1031. So right. Ideal. I've been in the real estate business for 20 years. I deal with a lot of people that wholesale and flip, and they keep stuff long-term. So I always tell flippers, you got to be really careful because you're a flipper and the IRS can see you're a flipper. But then when you're holding stuff longer and exchanging, they could be watching you a lot more when you're not a long-term holder, right? And then there's these debates. It's, how fast can I sell a property in 1031 to not get caught, so they don't identify me as a flipper. And, and I just tell people again, I don't know the rule. I haven't been audited, but I would ask you is, in your professional opinion, when a client calls you, what is the general rule for not being classified as the flip, and if you get audited, they're going to accept your 1031 exchange? We hear 1 calendar year. I've heard 2 calendar years. So I'd love to hear your take on that.
So there is no defined time by the IRS or regulations. So this is why it's so ambiguous. Now, when it comes to flipper, there's something called a dealer status. There's a lot of different criteria. In fact, there's like an entire 10-page technical paper on it. And so to give one bright line thing on it, it's usually the frequencies of sale and how long you've held the property. So if you're selling a lot of properties after only holding them for a short period of time, like a year or less, chances are you're going to be considered a dealer or a flipper in the eyes of the IRS. So that's the issue, without going too much into the weeds there. So if you're selling a lot of properties in a short period of time, probably a flipper. Now, when it comes to the 1031 exchange, there's also no defined timeline. So usually people will say the longer you hold it, the better. And if you hold it for at least 1 year, now you're reporting on your tax return. And some people will say that. Some people tell you 12 to 18 months. Interestingly, there are tax court cases out there where people have qualified for 1031 exchange treatment after holding their property for very short periods of time. And it's because when it comes to 1031 exchanges, it's about intent. What was your intent? Can you prove your intent at the time of buying that property was to hold it for a long time? So I don't remember the exact tax court case off the top of my head, but there's one situation where someone bought the property, they meant to rent it out, and something happened unforeseen, and they were able to get away. The tax court allowed it because their intent was to buy it. Something happened, and now all of a sudden they couldn't sell it. Whereas if you bought it, and now all of a sudden you're doing extreme amounts of efforts to sell that property, you basically flipped it. So in other words, you put a lot of work into it, and now you're going around marketing that property to sell it, and you're trying to do a 1031, and it was in a very short period of time, chances are it's not going to work. So I know it's maybe confusing there, but kind of bright, high level guidelines. If you're selling a lot of properties in a short period of time, chances are you're a flipper. You're not going to qualify for the 1031 exchange. If you're buying the property with the intent to rent it out long term, and you can prove that, and there's something that happens that forces you to sell, then you could probably qualify for a 1031 exchange. But it's risky to do that because in the eyes of the IRS on paper, it looks like a flip. And then if you really want to make sure you qualify for 1031 exchange treatment, probably best to hold the property for 12 to 18 months to make sure that it's bona fide. But that's, again, not to say it could be lower. It's just these are some broad stroke guidelines in an area that's extremely gray.
Yeah, thanks for that. I mean, that makes sense to me. I get it. If you're gonna, like you said, it sounds like if your intent was to hold it and you had a really good reason why you flipped, maybe somebody gave you some ridiculous offer and you're kind of like, I don't know if that'd work. But all right, let's talk about real estate investing real quick. So where are you at? Are you kind of investing? You kind of holding tight? What are you guys seeing in the market? What's your appetite right now?
Yeah. So for me on an investment perspective, I'm of the mindset that if you're I'm investing as a limited partner right now. So mostly in syndicates and funds. And I'm of the mindset if you're investing with the right group, with the right sponsor, that there's always good deals to be had. So I've made investments. I made my last multifamily investment actually in 2021 because I did think the market was toppy, and I made it with a good sponsor, fortunately, and I didn't get stuck in all this mess that's going on with people in the multifamily world. People use bridge debt, short-term financing, and a lot of times they use capital calls. Sorry, SOFR.
No, I said it was tied to SOFR, and it was at 30 basis points. Now it's at 500 basis points. Yeah, it's like, ouch.
Yeah. So these people had these bridge debt. The debt came due. They couldn't refinance it at a favorable rate, and they're forced to sell, or they have to do a capital call. They have to pause distributions. Luckily, I didn't get caught up in that mess. So now I think people are getting out of it. So I guess what I'm trying to say is now is probably a decent time for multifamily, from my understanding, if you're going to go into that. I have invested in industrial assets and car washes and ATM funds with reputable folks, and everything is going smoothly. So knock on wood. Now, going into this year, a lot of people think is going to happen is interest rates are going to be lowered and it's going to be a good time to buy. But I got to be honest when I say I don't know what's going to happen. I think if you're buying, you're sticking to the fundamentals of real estate, and you're buying in good markets, good properties, and good markets that are stress tested. In other words, like if you do the underwriting and you can survive the worst case scenario, then it's probably good to buy. But right now we're seeing mixed reactions, mixed opinions on what's going to happen this year in 2024.
Yeah, no, I totally agree with that. This has been great, Thomas. Where is a good place for people to find you, learn more about you? Maybe they want to contact you about your services, have questions for you.
Yeah, the best place to go is thomascastelli.com/links. I have my social media links. I have if you want to you can request a consultation if you are looking for a new CPA. So I have my newsletter, podcast, everything over there. That's probably the best place to contact me is that link.
And so I always ask everybody one final question. It'll be interesting to get your take is, what is your definition of generational wealth?
Okay, so interesting. So I read this book called Family Wealth by a guy named James Hughes, who basically studied this entire life. And it comes down to transitioning human capital and intellectual capital it's about developing human capital and transitioning intellectual capital down to the next generation. And money and financial capital is certainly a part of that, right? The corpus that can help fund the education and whatnot for the kids. But if you don't develop them and you don't transfer that intellectual capital, then you're going to have that rags to riches in 3 generations type of situation. So I guess my definition of generational wealth is building enough capital to support your kids, right? Being able to foster their education and their passion so they can go out and be productive members of society and keep perpetuating that down. And yes, you probably want to have some type of corpus or some type of wealth to help sustain that. But it's not all about money. You can have someone go and have $1 billion and squander in 3 generations versus someone has $50 million and perpetuate that on forever because they're developing their children, doing it the right way. So if that makes sense, that's my definition. Being able to develop children in perpetuity that are going to be able to be productive members of society, basically.
Yeah, I like that. No, I agree. I agree with that. It's funny. I've asked a lot of people that question. It's been fun to get a lot of different answers, but a lot of people do say it's not just the money you pass, but it's the wisdom. Because if you just pass the money and no wisdom, I don't know if you know a guy named Bobby Castro, but he's if not, look him up, but he's a guy sold a company big in multifamily, and he's done a lot of studying saying it's not the next generation. By the second, third generation, they spend all the money. And
exactly.
And so his passion is about teaching his kids, about the money, the legacy, this, then you teach your kids and this, otherwise it's going to be gone, right? It will. It just,
Right.
the third one gets in, they're like, wait a minute, it's just, private jets and bottle services and houses and it's done.
Yeah. No, that's exactly the way you just described is exactly the way I look at it. Like, it's like the question is, okay, if I can raise my kids, right? Like, I don't have kids yet, but I assume that when I do have kids that, I will be able to figure out a way to raise them. But then the real question though is, how do I raise my kids to raise their kids, right? To raise their kids to do the next thing. That's the real question. It's almost as like, and I think it's possible in today's day and age, with like the technology of video and being able to record stuff, like you might be able to pass down principles to the next generation.
That would be awesome, right? That's what I was thinking about. Yeah. You're like, here's my principal series. Like I'm shooting it for you guys need to watch this, right? Like,
yeah, exactly. I think like we're talking, it's like the same language right here. Yeah. That's kind of the way I look at it. It's the way I look at it.
Yeah. Well, Thomas, this has been fun. I was excited to have you come on. I know I asked you a lot of technical stuff about the CPA stuff, but it's really important because, I mean, I help a small amount of people in the grand scheme of just San Diego or the world, whatever. And I can tell you the questions, the concerns, the problems I see at a small level. So I know a lot of people are not doing taxes correctly. They don't have the right information. They're not taking the time to learn it. They're not asking the questions. And, there's so much information on books and podcasts and blogs and all that, right? But it's amazing. People are lazy about it. So I would tell people, get informed, reach out to you, listen, learn. And, if you get audited, you're definitely it will change your life because you'll be doing things different from that moment on. But I do appreciate clarifying a lot of things and helping break it down, because there'll be a lot of good snippets and reels out of this that will be able to go and people to watch and hopefully help some people out. So I appreciate the time, and it was great to meet you. And if you do come back to San Diego or come out, hit me up.
No, absolutely. Thanks for having me. This has been an awesome conversation.
So awesome. Well, hey, have a good day, and I hope we get to connect soon.
Okay, cool. Wait, this is still recording.
Yeah.
I was going to say, this is going to be edited, right? I was going to say, it'd be great to get you on our show. We have a Tax Smart REI podcast to talk about like lending, because people often have questions about lending, right? Like, well, what happens if my depreciation puts me at zero? Like, how do lenders look at that? That's why I deal with real estate investors. I'm like a pro at the taxes and lending and what they're looking for. All right, cool. So, I'll have, if you're open to it, I could have Patricia, she'll reach out to your people or whatever. Yeah. And we can get on the show.
Let's do it. That'll be fun. Yeah.
All right, cool. We'll do that. Thanks again, man.
Yeah, that was fun. Have a good day. Stay warm out there.
You too.
All right.
Bye now.
See ya. Bye.
If you're already a real estate investor, you know that aside from cash flow, you also get huge tax benefits by investing in real estate. But are you taking full advantage of all the potential tax benefits? We've been working with Tim Looney at CSSI for a few years now, and he's saved us and our clients hundreds of thousands, if not millions of dollars in taxes doing cost segregation studies on their properties. Let me give you a few examples. We bought a property in 2019. If we had just used straight line depreciation, we would have saved about $18,750 in taxes. But because we did a cost seg, we saved $258,000. That's $239,350 more than standard straight line depreciation in the first year. The other great thing is, if you're classified as a real estate professional, you can apply this to other sources of income like W-2 or 1099 income, and you can also roll over any unused depreciation to future years. If you've owned your properties for a few years already, don't worry, you can still do a cost seg and save big on your taxes. This is not tax advice, so consult your CPA to see if you qualify to take advantage of these benefits. Call or text Tim at 318-469-9861 to get your complimentary property analysis. Once again, that's 318-469-9861. And I'll also include his information in the show notes. You guys don't want to miss out on these tax savings.